And on the 3 syndications, we held them for about 1.8 years.
Okay.
And our average annual return was 41%.
That's ridiculous. Today, we have special guest Duc Ong. He's an agent and an investor. He owns his own brokerage and runs a small team here in Hawaii. And he's also a serious multifamily syndicator. He's a general partner in 13 multifamily deals and has already exited 5 of them. Currently has $65 million assets under management. Welcome to the show, Duc.
All right. Thank you for having me.
I'm so stoked to get to talk with you and just kind of see what you've done, because I feel like a lot of people can relate to you. You were a teacher, a high school teacher, before you started doing real estate, right? Is that right?
Correct. I taught high school math at Kaiser High School for 15 years.
Walk us through that transition. What were you doing? Like, how did you transition from being a teacher and then eventually turning into like a full-time real estate investor?
Well, while I was teaching, I had already started investing and becoming an agent.
Okay.
And then I essentially took the commissions from my agent sales to invest in real estate. Because I knew that I didn't want to teach forever. And like most people, I want to build the type of generational wealth that will free me from the bondage of working at W-2. I didn't want to just be in the rat race forever. So I realized that real estate is one of the fastest ways to get there. And especially multifamily real estate because of the economies of scale.
How did you, was there like an aha moment, like when you realized that real estate was going to be your path? Because you can go to the stock market. There's a lot of different ways to invest, right? What made you choose real estate over everything else?
Well, just from research, devoured tons of books, podcasts like Bigger Pockets, and just consumed a lot of content and started to put that into action by doing small deals at first and then scaling up from there. One of my first deals was a 3-unit in Indianapolis. It was a $75,000 triplex that I quickly sold within a little over a year for a decent profit. But part of the reason I sold was because I didn't like the subpar property management that's available at that level.
So you bought it in Indianapolis while living in Hawaii?
Correct.
So how did you feel comfortable like investing in something like so far away? Did you actually go and visit the property? How did you manage all of that?
Yeah, I was on a tour to look at turnkey properties essentially, and decided to partner with one of the guys on the tour to buy it. And that's one of the strategies that I've been employing ever since the beginning, is to partner with other investors in order to mitigate risk. And also stretch your down payment further.
Yeah, awesome. So when you're working as a teacher, how did you manage being a teacher and a real estate agent at the same time? I always hear people say that you gotta be a full-time agent whenever you become like a real estate agent.
I think you just gotta work more hours. But also most clients are also working W-2s and have jobs. So they aren't available during the day to go see showings either. So most people are available nights and weekends, so that tends to work out
So your client base is people who also have W-2s, and so when they want to see houses, maybe like after the school's over or on the weekends when you guys are both free anyway. That's what you're saying.
Yep, that's right.
Okay. And then like, what was like the was it pretty lucrative? Did you make more money as a teacher or as an agent during that time?
I definitely make way more as an agent than
really?
as a teacher, because you just don't make that much as a teacher in general. But the dollar per hour working as an agent is also orders of magnitude higher than as a teacher.
So so your full-time job as a teacher, you're actually making more money as an agent part-time basically. How many hours a week was that are you working as an agent?
It's hard to pinpoint because it varies depending on the deals.
It's such a fluctual, and it's a blurred line between work and playing, right? Because like part of being an agent is networking and just like meeting new people, and so sometimes it's actual work, but sometimes you're just having fun and meeting friends, right? So
but I'd say probably at least 20 hours.
Okay. And then so like we're 20 hours working as an agent, eventually like you're kind of building up, you're like saving money on the side or kind of building up like a down payment for your first deal, or how did you actually get started in like the multifamily space?
Well, so I actually took over the mortgage and title of a single family home in Anaheim for my family. Because at that point, in 2008, they got into financial issues and they needed help So I helped them, took it over. And then since I took it over, the equity position has increased. And then I just took the equity out via refinance and various HELOCs over the years in order to invest in that first deal.
Okay, so that was the Indianapolis deal.
Correct.
So I mean, like that. I mean, it's. I love the story because you come from very humble beginnings, right? You're working as a teacher. You're kind of moonlighting as a real estate agent on the side. Then you got involved in like some property that was slowly building wealth over time. You eventually took that equity and then you're able to do like your first deal in Indianapolis for $75,000, right?
Yeah, and then my second deal was actually a single family in Pittsburgh that I also partnered with a local realtor there.
Okay.
And the way I did that one was pretty interesting because for the down payment, I took out a bunch of credit cards.
Okay.
And I took out the cash advances and, paid the cash advance fee or whatever in order to do the down payment. Essentially, we bought it cash.
Was this like I know some of the credit cards are like 0% for like 12 months. Was
yeah, and then you just have to pay the balance transfer fee.
Yeah.
But just consolidate a bunch of those in order to buy that one cash initially, and then later we put debt on it.
Okay. So it was like you needed the cash and the credit cards to buy the house cash, and then after you can refinance it to like a long-term loan afterwards.
Yep. And then since then we've sold it.
Okay.
But, that was pretty risky strategy because essentially I was betting on the fact that I could make enough commissions from my agent business in order to pay off those credit cards.
Oh wow, okay. So it was kind of like you're cash advancing yourself as an agent to take out those little like, kind of like mini loans from the credit cards then.
Yep.
Okay, super interesting. So you did your first deal, your second deal, and then how many units was the second deal?
Just a single family.
Okay. And then when was the point when because I know like you joined the team of a few other investors to kind of start doing multifamily syndications. How did that transition or how did that process look like?
Yeah, so in 2019, I partnered with 3 other guys to do a 52 unit in Saginaw, Michigan. C-class neighborhood, working class, not the greatest area. But we managed to sell that since and made a handsome profit for our investors, our JV partners. But the important thing about that deal is that it gave us the experience to then do our first syndication deal, which was a 48 unit in El Paso.
So the first one was not a syndication; it was just a joint venture with some other people.
Yep.
And then how did you find these partners like to do the deal with?
Well, through real estate meetups and networking. Vince, one of the main guys I work with, I actually represented him on a purchase in Kapolei when he moved here.
So you guys were like, just like local meetups over here, you just like hanging out and you guys got talking. You saw you had some common goals and some different skill sets. Is that kind of how it all came together?
Yeah, essentially, Vince was just trying to find people that were interested and willing to partner on this deal that he had found. And we were just basically putting the capital in. And at that point, we didn't really have all the roles figured out and all the structure and systems. But eventually, we kind of realized, who's going to be doing what. And then, even though that was a JV, so technically, everyone's really supposed to be participating and working in it.
Yeah.
It turned out to be mostly me and Vince that did the work. So, we were eventually taking on those roles for our syndication deals as well.
What kind of roles are involved? Like, let's say you're putting a deal together. Like, there's defining the deal and there's actually running the deal, right? Like, what are the different roles that you're seeing that you and Vince took over that were that are important?
Well, so Vince does the operational side, whereas I handle the finance and investors. So in the JV deal, there's no investor relations to worry about. But in syndications, investor relations is an entire department. So right now that's mainly what I'm heading is finance and investor relations.
Okay. So can you break down all the different roles? Like, let's say somebody wants to buy a multifamily or do a bigger deal. What are the different kinds of roles total that are needed in a deal like that?
Okay. So other than operations,
when operations, you mean is that managing the property and the renovations or the rentals? Is that what that is?
Correct. Yeah. So operations entails managing the property manager as the asset manager, managing CapEx budgets, and running the actual value add program.
Making sure calling the property manager, hey, are you guys working today? Did you get any tenants? Those kind of things. So checking up.
And ensuring that the reports are updated and so we have these pulse check meetings every week that we're looking for certain KPIs from the property manager.
Got it.
And so the asset manager is responsible for ensuring that we're hitting the KPIs.
And then your role was managing like the funds, like maybe like the spreadsheets and like the talking to the people who are investing like as like limited partners. Is that kind of like your role?
Yeah. I mean, so on the finance side, it's kind of overseeing like cash management, treasury management, ensuring the balances, like we have positive balances. That's a huge thing. And then on the investor side, it's the whole back end of setting up the investor portal, handling all the SEC legal documents. And then just communication with investors as far as reports. So we send out monthly webinar updates for our deals for the first 12 months and quarterly reports every quarter and K1s every year. So all that stuff. So, I mean, when you guys were kind of just kind of forming the partnership, it was kind of like the Avengers, right? Or like the one guy's like, hey, I have like this deal, I have this plan. Let's bring together other people who can like kind of help me to kind of take this to completion. How did it end up where like you and I guess Vince were doing like the majority of the load? Like how did like that actually like, you know what I mean, like happen? Was it organic? Was it like intentional? How did that come about? Yeah, it's pretty organic because at first we just kind of assign tasks and then, just start doing the tasks. But then after a while, you realize, like who's good at what and who can do things more efficiently or just willing to stay up super late to do it. And like, there were like back in those days, many late night Zoom calls between me and Vince going over underwriting. For hours, just pouring over spreadsheets. So stuff like that.
I feel like there's always like a like when you're starting as an investor, there's like a point where people are paying their dues, where like you're just grinding, you're spending like a ton of time just analyzing deals or like talking through things, and then that's really where you grow as an investor. Your experience level kind of like skyrockets. And I think like just seeing where you guys are today is obviously you guys have probably done tons of like sleepless nights or tons of hours of just actually talking through and analyzing the deals, where now like the ability and the experience you have today like far outweighs where you were as an investor when you first started, right?
Yeah, I mean, you just got to put in the time. But I mean, I think that's the whole point of investing is to convert active like effort into passive. That you're no longer having to put in the grind in order to make the money.
The thing is, but you have to pay it somewhere, right? So like, I think if you pay it up front, like you put in all the work up front, eventually you're going to get a passive like results. But if you kind of like are passive in the beginning, you're going to always have to continue to put in the active results because you're never going to be able to build up that passive like income or the passive like business that you're trying to create, right?
Yeah. And then I think some people kind of do it in the wrong order where they're already looking for investment opportunities without having made the money. I think the first step is you got to make the money like via the active means, and then start saving. And then, once you have that like set aside, then you have an investing problem. Like a
cash reserves, you mean like put like actually have like generate some income in the very beginning. It's very hard to start with like absolutely $0, right? I mean, it's possible, but it's not really like, I guess, responsible, I guess, to do it like that.
Well, yeah. I mean, there's all these like, strategies out there for no or low money down and all that stuff. But, there's a downside to it too. So, I think if you can combine multiple things like, the low down payment with a partner and like all these different things, like that can help you kind of get started and do that first one, because that's always the hardest one.
Was there any kind of like lessons you've learned from just partnering with different people as far as just like what to look for or what not to look for when you're trying to find partners for your deals?
I think it's important to find partners that are going to be able to, complement your weaknesses and just be self-aware and like realize what you're actually strong at and just be honest with that. And then also to be clear as far as communication and lanes and roles and responsibilities. And we like to manage everything in Google. So we have like Google Sheets for everything.
I love Google Sheets, by the way. Our team uses Google Sheets too, and we love it. Just the collaboration that can happen, right? It's all in the cloud. You can update at the same time. You can see what changes people are making. There's like version history. You can see like who screwed it up. I think in the last week, I'm like, what the? And then like who can I blame for like the mess up and stuff, right? So
yeah, everything's trackable. Yep. Yeah. No, I mean it's key to have everything written down and clearly delineated.
What do you think is like maybe like your superpower? Like, I mean, like I feel like you're like one of like the, I guess, smartest or most like you just get stuff done. Like from ever since I've known you, you've always been so responsive. Like anytime we ask or need anything from you, you always like you're instantaneous as far as like getting back to us. And I feel like you're a team member that gets like a lot of stuff done like very quickly. What do you think like what's your superpower that you would say like what's your superpower, would you say?
I think it's analysis and problem solving and being able to find an efficient path. When I'm given a task, I don't just like do it blindly. I always try to think, well, first of all, can I delegate it to my VA?
Okay.
And then if it's repeating, then I need to create a system, a playbook for it so that it can be done over and over. And then what kind of triggers like would lead to this request coming again? And so I kind of think about those things. And it's like really like the only I can do it, like sensitive financial information, then like I'll just do it immediately. And just the various productivity tools to keep track of all the tasks.
What kind of tools do you guys use like productivity wise?
Asana is one tool for project management that we use as a team. So we run that across all of our businesses, and Slack for communication.
We love Slack too. Slack is awesome. You mentioned playbooks. You guys like create playbooks for like your virtual assistants or your team members. What do you guys write playbooks in?
So I just make Google Docs. So I have like a master playbook that has links to all the various playbooks. And basically, as soon as I can think of tasks that are repetitive, then I try to make a playbook for it. But the key is that I don't necessarily write all the playbooks. I wrote some of the first ones, but then I actually assign that as a task to the VA to write the playbook. And then what I do is I go over the tasks in Zoom, whether live with the VA or just record it in Zoom, so that they have a screen share that they can refer back to, and they can take screenshots of that video in order to make the playbook.
Oh, wow. So your time is like really efficient, where you're actually like working through the problem with your virtual assistant. Your virtual assistant has a recording of it, and they can rewatch it and then create the playbook based on the recording that you just did with them. So I love it, man. I might have to steal some of these ideas from you. So
yeah, and I think this time is the most valuable resource, and that's kind of the whole point of all this wealth building. Because I guess actually my primary goal isn't necessarily to maximize my net worth, but it's to maximize net fulfillment. A la Bill Perkins' That with Zero kind of philosophy.
Explain that to me.
So in the West, in the materialistic kind of culture we live in, most people are trying to maximize net worth blindly, like without any kind of reason necessarily.
Just get rich, basically. We want to have a nice house and a nice car, right?
I just want to see that number, right? It's just a scoreboard. But to me, that is not the entire point. Like money is a tool in order to do the things that you want, to have the experiences that you really want in life. And so there's kind of an optimal point in your life that you can do certain things. So if you just put off everything until you're old, then you won't be able to do the things that you wanted to when you were young.
Just like travel or like spend time with family, all the different things that as you get older, it's like less, like it's harder to do, or it's like less enjoyable and stuff.
Yeah, I mean, well, I'm a father of a 1 and a 3-year-old.
Okay.
So right now they're young and they're not going to be that age again. So I really value spending time with them and being there for them. And so that's kind of the point of like financial freedom and building wealth, is to be able to spend time the way that you want to.
I love that. I mean, like, talk a little bit more about that. Like, I think that's like a really crucial point, that just to kind of like to sit in is like, I think a lot of people get swept up in financial freedom, and like they want to ride in a jet, they want to drive a Lambo, they want to do all these things that are just seem flashy because that's kind of like what Instagram quotes as success, right? But then the reality is, it's just like the day to day, like the time you get to spend with your family, with your wife, with your kids, or things you enjoy doing, whether it's like golf or pickleball or like shooting guns or whatever it is that like kind of like fits your fantasy. It's just being able to maximize your life, so.
Yeah. And in Bill Perkins' book, there's like these different buckets in your life that you can only do certain things. Like, let's say in your 30s, you can go climb a mountain like Kilimanjaro. But you wouldn't be able to do that when you're 80. Yeah. So you should do it when you're 30s. That's the best time to do it. But if you just, build wealth forever and you never spend it down, then you're going to be at a point where like, oh, you have all this money, but full of regrets, right? Not having, taken that trip.
That's a super good point. So at what point do you think it's because there's a balance, right? Like you can't just be spending like on credit cards, just going on vacations and enjoying your life, but not building wealth. But there's also, you can't just be building wealth and not being enjoying at the same time. How do you strike that balance of like building wealth, but also like living your best life as you're doing it?
Well, I think you just need to build wealth as fast as possible.
Okay.
Like that's the solution because, well, I mean, that's how Bill Perkins did. He's a trader. He's an energy trader. So he made a lot of money trading. And then now he's living the life, right? But that's the correct order. He built the wealth first.
So you hyper focus and just like try to make as much money as possible. Then over to like that, after you kind of have that first jump, now you can actually invest that or like turn into passive income or kind of ride the coattails of like the work you've done in that first, like let's say 3 or 5 years that you did.
Yeah. I mean, and you can always inflate your lifestyle and then it's just a never ending race. But it's important to keep it in perspective and, not just keep buying more and more expensive toys as your income and wealth increases. But also just to, remember the whole point of doing all that.
I love it. I think one of the other things you guys are doing with the multifamily investing is you guys are actively investing in these multifamily buildings, but you're also having an opportunity for people to invest passively. So like a guy like myself, let's say like I have some extra cash lying around, I can actually invest with you. You're going to make my money grow or give me a monthly amount. And then now I can live my best life based on the hard work that you guys are doing, right? So
Yep. Yeah. So of the 5 deals that we've exited, 2 of them were JVs, 3 were syndications. And on the 3 syndications, we held them for about 1.8 years.
Okay.
And our average annual return was 41%.
That's ridiculous. Can you break down like the numbers of like the best deal?
So Green Desert was a light tech deal in El Paso.
Okay.
That we bought that at 1.935.
Was that, is a multifamily?
Yeah, 48 units.
48 units, okay.
It was through our property manager's connection.
Okay.
His cousin was a lawyer that had the connection to the light tech people. So we were able to get that deal off market at a good basis. And then within 2 years, we sold it at 2.9.
So you bought it for 1.9. In 2 years, you sold it for 2.9.
Yep.
Did you put in like a renovation or was it like that?
Yeah. We did our standard. I mean, not as much as some of the other properties because it's light tech. So there's kind of limitations to how much you can push rents because of the light tech restrictions. And despite the fact that it's still in the light tech, it will eventually come out. And that's where the big pop will be for the next buyer. Because once the light tech restrictions are over, then becomes market rate and then it's valued differently.
I see.
But yeah, no, on that deal, our passive investors, let's say you invested $100,000, we would have returned $103,000 on top of your $100,000.
So if you put in $100,000, you would have gotten $200,000 basically in 2 years, and just under 2 years.
Yep.
Which is an amazing like return on that. And they didn't do any work where you guys are doing all the work.
Yeah, completely passive. Yep.
That's not. Sign me up for those deals every time, man. But so what is like the I guess the key to like having like a deal like that successful?
Well, I think it has to do with the execution of our operations. And then, the acquisition is the most important, the basics.
Buying at the right price, you mean, so.
Yeah, being able to get at the right price. And also our timing. We were able to exit it before the whole rate going up.
The markets were still good. Like it was a booming market. So you guys had, you timed. That's why you exited in 1.5 years as opposed to like 3 or 5 years because the market conditions were right.
Yeah, and then as GPs, that's our responsibility.
So GPs, can you explain that a little bit?
General partners. So we're on the active side. Okay. So we manage the asset and make the day-to-day decisions. We're always trying to acquire. So we're always underwriting and looking for deals. So we're always evaluating the market. So if the opportunity comes, then we'll look to sell. Especially if we can hit our projections earlier, because that juices the internal rate of return. Which is a measure.
There's a lot of numbers or acronyms you're throwing around over here. So like the GP is a general partner, right? So that means basically on a deal, you guys are the ones who are managing and finding and doing all the work. And then there's the LPs, which are the limited partners, where they're providing the funding and then they get like a return for like the part of the profit split, right?
That's right. Yeah.
And then internal rate of return, can you explain what that is?
Yeah, so internal rate of return is a measure that's typically used in commercial real estate that measures the rate of return when time value of money is taken into consideration.
Sounds very complex.
So, so if you think about when you get the money, the earlier you get the money, the higher the IRR.
Okay.
So if you had to wait until the sale to get your money, then the IRR would be lower. But if you got some of that through the hold via cash flow, then your IRR would increase.
Because you can already put that money that you got back to work again, right? So that's kind of the thought process behind that.
Yeah, so it just measures the speed at which you get your money back.
So it's like the return and the speed kind of combined together into like one metric, which is internal rate of return or IRR.
Yeah, I mean, and the formula is much more complicated.
Yeah,
it has to do with
that's like
flows,
the super basic kind of like a high level like idea of what you're trying to accomplish.
Yeah, I mean, that's basically the bottom line is the faster you get your money, the higher the IRR.
Yeah, I got you. Yeah, so I mean, like what are you guys doing now as far as like you said you have like 8 deals going on right now. Are you guys buying new deals? How are you sourcing new deals? What does like your operation look like right now?
Yeah, so today we just got under contract to sell one of those 8 Bay Street.
Okay, congratulations.
Thank you. Yeah, it's in Berlin, Maryland.
Okay.
And we are also under contract to buy another one in DFW.
Okay.
That's supposed to close mid-December.
Okay, amazing. And so do you think the returns would be like similar to the ones in the past, or because the market is a lot different than it is like back then, right?
Well, yeah, I mean, and of course our past returns do not dictate future returns.
Yeah.
But yeah, I mean, we generally project for about a 2x equity multiple over 5 years. That's kind of our target for our underwriting.
Okay. So I mean, like when the people sign up for those deals that they got like almost like a 40-something% return, what were your projections on the front end when people were signing up for that?
The same, the 2x equity.
So like a 20% average return, but then like in actuality, you guys return a 40+% return, even though like they're projected at a 20-something%.
Yep. Yeah, and that's how we like to underwrite is conservatively, so that we have room to outperform those targets.
I love it. I love the strategy. So let's take a look back into like to your story. So you started out as a teacher, you became an agent, and then now you're a multifamily syndicator. Are you still doing real estate as being on the agent side?
Yep. Yeah. And in fact, I have a listing in IAEA that just went on a contract recently, a loan assumption. So it's going to take like 3+ months to close.
Really? So is that like talk to me about the loan assumption. Because I think I've been seeing more of those lately in the market where it's such a hard time to sell because like the interest rates are so high, but then you can actually assume as someone else's loan. Can you explain that to us?
Yeah, so I've actually closed another deal in Kailua that was a loan assumption where I represented a seller. And yeah, you just have to be really patient because it takes a long time. The lender has no motivation to approve your paperwork because they don't get any more money. Like it's the same loan.
So also like when the loan assumption happens, the lender doesn't get any points or any like profit from it?
Yeah, I mean, it's minimal fees and stuff. And, they're stuck with the same low rate that the previous buyer had. And yeah, it's just tricky and it takes a lot of patience and all the parties need to cooperate and got to keep on top of everyone. But it's possible. And it becomes more and more attractive in a higher rate environment, especially with rates sub 3 that some people
Why
have.
would someone want to sell with a assumable loan? Like what benefit is that to the seller?
Well, it allows them to attract more buyers that are willing and able to take over that loan. And for the seller, it's not as ideal as just a clean sale without it. But if you have no other options and that's the best offer, then that's the best option.
So are you representing the buyer or the seller in this transaction?
So in both that past one that closed and the current one in escrow, I represented the seller.
Okay. And then what's the interest rate that the seller has on their mortgage right now?
It's like 2.875.
That's ridiculous, man.
Yeah.
So you can buy a house, but you can still buy a house now with 2.875 as long as the sellers will allowing you to assume the loan that they have.
Well, the other tricky thing is you have to have the down payment.
Okay. The difference between like the mortgage balance and like the price of the house, right? So
yeah. So I mean that could be substantial depending on the deal. And in that first example, the buyers actually came in with the second position to cover the gap. So they didn't have to come in with the entire down payment. They had a second position to support some of that gap.
Oh, wow. So how did they come with a second position?
I mean, the Freedom Mortgage, the first lien holder allowed them
they're allowed to have so they had 2 loans. They took over the first assumable and then they got a second mortgage or a HELOC or something on it to to cover the difference. And so like they basically can come in with like a less amount down payment just to purchase the house.
Yeah, so I mean that could be a viable strategy for buyers out there.
Oh, that's really interesting. Can you, I mean, like, I think we glanced over that really quickly. Can you just break that down a little bit more methodically on how that whole process works?
Yeah, so for example, let's say the loan to value.
Let's use like numbers. Like, so like there's a house for sale in Kailua for $1 million. But nobody wants to like that. So yeah, so like let's start there.
Yeah, let's say $1 million. The loan balance is $800,000.
Okay.
At like 3%.
Okay.
And so a buyer can come in. Let's say they only have $100,000 instead of $200,000.
Okay.
They want to buy it for $1 million, so they could go assume the $800,000 loan from the first lien holder, and then take a second position loan at $100,000, let's say, to bring it up to 90% loan to value, and then come in with $100,000 down to cover the rest of the gap.
I mean, so that's amazing. So like, yeah, the 800,000 would be at 3%, and then the second position, 100,000 would be at like the 7 or 8% that is today. So like, the majority of your mortgage is still gonna be like a lower percent, but you have like a small percentage that's actually like a little bit higher percentage.
Yeah, and then you might get like a blended rate of I don't know, 4% or something, but still much better than the current rates. Yeah,
like the last 7 or 8, right? So I mean, I feel like that's a strategy that like people should actively try and pursue like in this market, just because it seems like it's like this is like the perfect market to actually apply those strategies. And so if they're aware of that, then like that's something that they can do today. So
yeah, and it's tricky because you really have to find that like perfect situation where the seller is willing to do it.
Because there's a lot of work on their end as well, because like they got to go through the process on the paperwork. It's gonna be like a longer close for them, etc. And so interesting. So I mean, like you also have a small brokerage that you run and some agents. Like how is that going for you so far?
That's good. It's just new startup, so we're just starting out. We're recruiting and building our agent base. And the thing that makes us different is we are trying to turn agents into investors.
Okay.
And we want to give them the blueprint, hence the name Blueprint Real Estate Advisors is the name of brokerage, which to me is first you earn commissions. So that's considered active income. And then you take that active income and, once you are able to support yourself and all that, then you invest in deals that can produce passive losses. Like our multifamily syndications. And then once you rack up the passive losses, because you could qualify for real estate professional status, which check with your CPA on how to do all that. But that's a special designation in your taxes that allow you to take the passive losses from multifamily syndication deals, for example, to offset active income from your commissions. Yeah. So essentially, it's a way to pay as little taxes as possible. So
you're kind of pairing both worlds together, like the active on the real estate commission side, investing in like the passive on the syndication side, and eventually, like you're trying to turn them into investors where they're moving more from like the agent to more investor, like over time. Is that kind of like the thought process?
Yeah, and then if you're good at being an agent, then my advice is just keep selling houses because that's like one of the highest dollar per hour jobs out there, especially in a market like Hawaii. But then, don't just blow your commissions on toys. Like, put it into assets that can then produce both passive income and passive losses. And passive losses in this case are paper losses, the depreciation, which just on paper, like on your taxes, will show as a negative, which allows you to offset other income and then not have to pay taxes on that income.
I kind of like, it's almost like the Duc Ong blueprint, because like it's exactly like your path, right? So start as an agent, make some income, and then eventually like do some like limited partners, and eventually like become more active. But it's just like it's a proven way of building wealth, and like with a practical steps, right? Like that, you don't have to start. You can still have a job. You can be an agent on the side, start making some commissions, put away some investments, and eventually maybe go full-time agent after you become enough success. But like it's a very practical way to kind of get and start in real estate investing without a lot of the risk that like it might seem.
Yeah, and then this strategy can work well if you have a spouse who has a high income job, like doctor, lawyer, that kind of thing. Because if you filed married jointly, then you can then use one spouse's real estate professional status to offset the other's W-2 income, as long as you have enough passive losses. So you have to keep participating in deals that can produce passive losses.
Super, super interesting. Do you guys have like webinars or things where you get to teach more about these kind of things?
Well, we have a monthly meetup,
Okay.
Honolulu Multifamily and More.
Okay.
We're on Facebook, and we have every month. So that's one place to find us. And then we also have a podcast, the Cash Flow Project podcast, where we
you guys have a podcast too. Right? I think I was actually a guest on there like way back then.
You're one of our first guests. Yeah.
But just running a podcast, how's that been? Has it been helpful for you guys? What has that been like in like the whole podcast process?
I think it's good. I mean, I think in this current age of capital raising, creating content and content marketing is like a given. Like it's it's just you just have to do it. If you skip it, you're gonna fall behind. So it's just all part of the normal way of marketing and the modern age.
I feel like social media and just like the digital marketing, like you're saying, has played such a big role in our company and our team as far as just being able to like do more deals and like find more partners and things. And like I think it's like the big thing is people don't realize how much work it is. I think so. Like you see like the highlights and everything from what like the content, but there's so many hours of like the filming, the editing, like the pulling it out, like having a team on there doing all of the captioning, all these different things. And so it's super like helpful, but it's also like you have to be prepared for like the amount of work that's be involved when you're kind of starting out on the social media and the whole digital landscape.
Yeah, and it's one of those things that like you can't really see the fruits of your labor immediately because one thing I've learned is that you're not really creating the content for like the likes or the shares or whatever on that particular piece of content. What you're trying to do is just build an audience. And then with that audience, then you can do stuff.
That's a really, really good point. I think real estate investing in general is like that, where there's so much work that's done in the front end that like doesn't pay off, and there's no immediate like gratification. So like let's say you're analyzing deals or you're putting in offers. There's so much effort and work that's done there, but then like the gratification is like way down the line. And then like you get like it's nothing, boom, then you get a huge sum, but it's actually all these like small steps that were like got nothing that actually led to that big profit or that big like windfall like down the line, right? Very similar to like social media where like you're putting out content, and then maybe like nothing. Okay, you get one deal, or like well, content, you get one partner. And so like it's kind of like you have to have the faith that what you're doing is actually working, and to make sure that like you're consistent with it over a long period of time in order to kind of see the fruits of all the work that you've done.
Yeah, and then you never know where investors could come from. So just kind of putting yourself out there, putting the content out there. Sometimes just randomly, like through various other connections, like people will find you and like, they've heard of you through this or that. And then that's all part of the trust building that's necessary in the capital raising business.
So true. So let's say somebody who's just kind of brand new, they're just starting out, they want to kind of get started in real estate investing. What kind of advice would you give to somebody like this?
Well, first, just get educated. There's so many free resources out there. But secondly, to partner, go to meetups, go network, shake hands, meet as many people as you can in your local community, and try to learn from them firsthand, and then find partners, because partnering is one of the best ways I find to kind of get over that hump. Because some things that you're not willing to do or not good at, if you can find a partner that will do that, then you'll move much faster as a team.
So when you're trying to find partners, are you looking for somebody who's more experienced than you, less experienced, or what are you looking for when you're trying to find a partner?
I think you should find someone that's like around the same level, that's kind of, on that path as well. Like, let's say you're just starting out, then, find someone that's also kind of just starting out. Obviously, it's better if you can find someone willing to partner with you with more experience. But that may not be feasible because, like
depending on what you bring to the table, you mean?
Yeah, because let's say you brought a good deal. Then that would always get you a seat at the table. If you can raise capital, those kind of things. But other than that, like, why would an experienced investor want to partner with a newbie? There's got to be some.
So like, let's say like there's a new investor who wants to partner with Duc. What would he need, or he or she need to bring to the table for you to say like, hey, this makes sense for me to want to partner with you?
Well, on our deals, which are mostly syndications, we take limited partners. So we take passive investors. So as long as we have some kind of relationship, we can bring the investors on. But as far as getting on the GP, that's much harder. In order to do that, you have to be able to bring something else to the table other than just your cash. Like, for example, some kind of skill set or, being able to raise capital.
Super interesting. So where are you guys kind of going for as far as just like the future? What is the future of... What is the name of your guys' company, actually, by the way?
So Tri-City Equity Group, is our real estate private equity firm.
Okay.
Our focus right now is on the Dallas-Fort Worth area.
Okay.
We currently have 4 assets and under contract to buy the 5th one.
Wait, so you have 4 assets in the Dallas-Fort Worth area, and you're trying to buy a 5th one over there?
Correct. Yeah.
Okay.
And then so we have 4 that are not in DFW.
Okay.
That we're trying to sell.
Okay.
So
you guys really like DFW?
Yeah, because what we discovered is previously we were like going a mile wide, just going to all these different markets.
Because I know you said you had one in Maryland, you had one in like El Paso, and so like the...
Well, so we've sold all of our El Paso assets.
Okay.
So currently the other 4 are in Roanoke, Virginia area.
Okay.
Berlin, Maryland, and Johnson City, Tennessee.
Okay.
And we are trying to sell all 4 of them.
Okay.
So that we can focus on just DFW, because we're setting up a property management company. Actually, it's already set up. We've been operating it on 2 of our assets. And then we're going to eventually take over the other 2 and this new property. And with vertical integration, we can control the whole process.
What is vertical integration? Can you just explain what that term means?
So it just means to self-manage, to manage using our own property management company instead of using a third party property.
So what you're saying, like, I think in a real estate deal, there's a lot of pieces and parts, right? There's like, you find the deal, you manage it. Like, let's say you pay for the contractors, you're doing all these different things, but the more kind of like pieces that you can put under the same umbrella that like you guys own and operate, that's kind of like how you're like making a vertical integration with all the different parts and pieces.
Yeah. And the motivation for that was that we found third-party property managers to generally be subpar. Okay. And they're better than like small multifamily or single families. Okay. Like, they're just atrocious at that level, but still, like, there's like, small little petty theft, just fraud, just negligence, all these little things we find. So like really the only way to solve that is to do it ourselves.
Just do it yourself. I got you.
Yeah, and to control the whole process. And then with that, we'll be able to pass the savings on, down to the bottom line, to the NOI. Which is what matters for investors.
Yeah. Amazing. Well, I mean, so awesome to kind of hear your story, and I especially like your take on life as far as just building wealth for time as opposed to just building your net worth. I think that's like a super huge takeaway for myself personally. But if people want to find more about you or connect with you, where can they do so?
Also, tricityequity.com is the website for Tri-City Equity, and then blueprintrea.com is the website for Blueprint Real Estate Advisors. So if there are any agents out there that are looking for a different path to build wealth and not just chase those commission checks forever, please contact me. And as far as investing, we're always looking for passive investors. So if you're interested in that, then also let me know.
Awesome, man. Well, thanks for having me. Thanks for jumping on the show today. Super appreciate you, Duke.
All right. Thanks for having me.